Welcome back for the second episode of The Big Picture in partnership with MarketReader. And welcome, Jens. How are things?
Things are good. Things have been very, very busy since we spoke last time.
Yeah, incredibly busy. And a few interesting insights that I'm keen to revisit from our previous discussion. Namely, the call that you made in the last episode, where you argued rates would peak due to lower inflation concerns, which in turn would support risk assets. Incredible timing, I think, on your part. But perhaps you can just start by explaining the narrative surrounding that call and the data you were looking at to make it.
Yes, I think we've been really like in a multi-year period, right, where rates were going up and up and up with few interruptions, right? And then over the last period in which rates were rising, it was there was something new about it, and that was that people had these concerns about the long end of the bond market. And what's different about that is that if the long end of the bond market starts to really move in a way that kind of short circuits how the Fed thinks, because like if you have tightening through the long end, then the Fed has to do less in the short end because they get the tightening through the 10-year bond, 30-year bond, and so forth. And I think that's exactly what we've seen play out, that the long end moves so much that the Fed started to get actually reluctant to do more on its end and started to talk more about financial conditions having moved and so forth. And then on top of that, we did have an inflation print that showed some real broad-based improvement for the first time. So what I like to look at when I crunch the CPI numbers is to really dig into what's going on in services, right? And the reason why the Fed has been very reluctant to sound more hopeful on inflation was that on services prices, things look very sticky, even if headline inflation has been coming down. And the last print sort of changed that. So I like to look at medians, right? So instead of stripping out various things of the basket, just look at everything, rank them and say, okay, where's the middle of the inflation distribution? And for services, it actually was analyzing around 2% in the latest print. I'm not saying we're at 2% target yet, right? But we came from having been around 4 for effectively 2 years. And then in the latest print, it was for that month around 2% annualized. So a big improvement. If we have another couple of months of that, then the Fed will be able to move to a totally different narrative. And that's what the market's starting to sniff. And together with also less extreme concern about supply, right? So we've had auctions that have gone we've had auctions that have gone well, we've had auctions that have gone mixed, right? But it's sort of more of a mixed picture where this supply concern is really going to drive everything. So all those things together have led to a big rally, and it surprised a lot of people, both in the bond market, because people were so focused on this supply issue, think of we're going to have supply issues forever, and that's calmed down. But also in equity space, right, where people thought, okay, we are getting close to this lower growth point where equity is finally going to flip over. But in fact, it's been the inflation that's dominated, right? So the move in rates, the move in inflation expectations have supported risk assets. And like we've effectively had a 10% move in the S&P, right? So a very, very big move in a short space of time. And obviously we can see it in all global risk assets. The dollar has had a pretty meaningful move as well. Yeah, I think we can be pretty happy with the timing of the first show we did. I think it was, if it was not the very peak in rates, it was within a couple of days. So that's going to be hard to do every time. Now the expectations are we're going to call some kind of major turn in AI stocks today. So there's a lot of pressure on us for this specific topic today.
Yeah, well, exactly that. And as you say, we'll move on to discussing AI's impact on financial markets in general. But before we do, obviously you discussed there the big sort of broad-based rates rally that has seen stocks stage their recent run. But looking forward then, do you expect momentum, particularly in stock markets, to continue into 2024?
Yeah, so we have a few weeks left of this year. So I think for this year it's going to be hard to fade what's going on. Like we spend a lot of time looking at the positioning indicators, right? And we can use the dollar as an example, right? The dollar has been on a multi-year strong run, bull run, right? And we've had a dent in that now over the last 4 or 5 weeks. But the various positioning metrics that I look at still suggest that there's potential for sort of momentum selling of dollars. And I think the same thing pertains to equity markets. There's going to be fund managers that perhaps not have met their benchmark, right? What are they going to do into a year end? Are they going to fight hard what's going on? Or are they going to get closer to benchmark? So there could be some technical buying there as well. So I think for the remainder of the year, I think it's hard to fight it. But I'll go back to the sort of transition that we already talked about at the last show, where we said, okay, initially we're going to have a period where risk assets are going to be supported by inflation, concerns coming down, concerns about bond supply also being less extreme. And that's sort of pretty bullish. And then the question is, are we going to have a transition where we transition into thinking, okay, now we're going to go into a regime where it's more the concern about growth that is going to drive things. So I think as we head into Q1, we could have that transition. We're starting to see some data points in the US that look more shaky. We've had home sales figures over the past few weeks where it is definitely, we can use dramatic terms like falling out of bed, but like it's really breaking out on the chart. And it shows once again, right, that the economy has been more resilient to rates than a lot of people thought, but nevertheless, the housing market is definitely feeling the pain. And the lags are complex, right? But now it seems like a lot of these housing indicators are really shifting down a gear. And then the question, I think, is when are we going to have like a confluence of growth factors that actually reset growth to a degree where the labor market starts to feel the pain, right? So it's very hard. A lot of the US data is very hard to analyze because the seasonal adjustments are so messed up by the special circumstances around COVID that actually it's almost like all the data that comes out now, I like to look at it in the way it comes up on the screen. And then I go back to the raw data and look at it non-seasonally adjusted to not get too, enamored by whatever seasonal adjustment is in place. But anyway, trying to strip all that out and think about where we're heading. I think we're heading in a direction where housing related stuff is very weak. There's a bunch of stimulus effects that are fading. There's some tax credit effects that are coming out of the equation. Overall income growth is also moderating, both from the wage front and from the job growth front, not abruptly, but gradually. So I think as we get further into 2024, there is a risk that this shift from low inflation is going to move into, okay, growth is actually also meaningfully weaker. Earnings is going to be impacted. But I don't think it's going to be necessarily January 1. So it could take a couple of months before we get to that point.
Yeah, got it. Okay, well, with that in mind then, I think a topic that came up kind of loosely within the previous discussion we had on episode 1 was AI and its impact on markets, but more fundamentally, its impact on the macroeconomic environment as well. So that's something I think we decided during that episode we should cover. So we'll move on to that subject now. But I think as a result of that discussion, we'll move back and we'll cover some of these more macro topics anyway. I want to start with stocks, the stock market impact. Microsoft, for example, is up over 55% since announcing its multi-billion-dollar investment in OpenAI earlier this year. And obviously a lot's gone on with those two businesses since. Other mega caps, though, if you kind of expand that out to the impact on the Magnificent Seven, as they're called, has seen similar outperformance, I think up 71% over the past 12 months aggregated. So I want to start by discussing whether, because a lot of people are discussing whether they think AI is a bubble, whether we're in an AI bubble. So I want to get your take on that, and then I think we can explore the topic more fundamentally.
We can start with NVIDIA, right? So NVIDIA is the company that has sort of really put AI on the radar of everybody who is involved in the stock market, right? Because we've seen such incredible earnings performance and incredible stock market performance from that company. And we continue to see them delivering on the explosive growth, right? So when a company grows key segments 30% per quarter, you say, okay, that's a high growth company. But what's really unusual about NVIDIA is that it's a very, very large company, right? It's not like some company that started yesterday and they're ramping up their sales. It's a huge, huge company, and they delivered once again in the latest earnings release, right? So it is amazing when you look at the performance of that stock, right? That and I've done a number of polls on Twitter throughout this year where I said, okay, would you rather like to trade NVIDIA short or long? And lots of people want to trade that stock short, right? Because the valuation looks extreme. But if you have a company where earnings are moving up very dramatically, and the headline sales growth is 30% a quarter, the valuation can change very quickly. So what used to be a 50 PE stock becomes a 20 PE stock pretty quickly, right? So it's all about how long you think that growth can continue, and also obviously whether they're going to get competition from different companies. Actually, the whole debacle we've gotten around OpenAI in the last few weeks, I think, is related to that, right? Because some of the leadership within OpenAI, I'm not going to mention names, but let's just say some of the leadership had ideas about producing chips on their own, right? Because the real bottleneck now in terms of training systems using these incredibly large data sets has to do with the sheer processing power, right? And we have a shortage of the most high powered chips, and that's why NVIDIA can charge the prices they have been charging, right? So we are definitely at an inflection point where lots of players will try to come in and grab that market share, right? But it is not something you do from one day to the other. Like producing a whole new generation of chips and getting them in mass scale production is very hard to do. So I think NVIDIA has a window, and I think it's very hard to say that the clear market leader in this space is an overvalued stock. Like, we can have discussion about is the valuation extreme? How long will their growth continue, right? But if they continue to grow for a couple of years at this pace, it's not an expensive stock. So it's just a matter of how long you think they can maintain that leadership position. I don't think there's any doubt that the AI market overall is going to continue to grow tremendously. Like, I speak to CEOs all the time where we in a market reader context, right, use AI in a very practical way. Like, we've generated a system where we can explain why markets are moving in real time, right? And we get that type of insight in front of users in a way that has not been seen before. And we couldn't do that without AI. Like, even just the presentational aspect of using language rather than math to convey insights is very, very powerful. Like, there's a reason why Twitter became we're not allowed to call it Twitter anymore, but the application phone known as Twitter, there's a reason why that was very popular, right? Because people really like to ingest these bite-sized pieces of text, and it is totally different from having like a couple of statistics thrown out at you what's going on, right? So AI is very powerful in that regard. All kinds of large corporations that we speak to have AI as the key investment focus, right? But it's going to be a multi-year process, right? It's not something that is over in the next couple of quarters. I think a lot of people are experimenting, ramping up. And then when they find a kind of fit in an area, they're going to say, okay, now we're going to go aggressive. Maybe here we're going to do our own training, right? So there's some leaders that are clearly investing very, very hard. You know, the big people in the space that have spent billions of dollars on training their models: Google, Meta, obviously OpenAI. Microsoft separately, Amazon, but there are lots of other big corporations that want to do their own work, do their own training, and they're going to need processing power. And that's going to be a multi-year process, because I think a lot of what's going on at this point is experimentation, and the big investments are going to come once the initial results of the experimentation has come through. And that's why it's going to be a very drawn out multi-year process.
Yeah, interesting. You sent me a chart. I think it was KPMG's 2023 US CEO outlook, and 62% of the surveyed CEOs had their expectations at a return on investment in AI over the next 3 to 5 years. So that completely correlates with what you're saying there. But if we move back to, you were talking about valuations there, and obviously NVIDIA is a really interesting one. There, and I can put this analysis in the episode description as well. There's a guy that we've spoken to previously on the podcast that has NVIDIA at undervalued, so similar to what you're saying, but expects that window that you were talking about there to last over the next 2 quarters. So he sees it as a relatively short-term window in which that valuation makes sense, and then beyond that, he expects to see more competition in the market. But if we move back to how this phenomenon is affecting stock markets, the AI kind of boost to stocks, for want of a better term, has been extremely concentrated in those few big companies that you referenced a moment ago. Those are the companies that have access to huge amounts of trading data, for example. They'll outcompete those businesses that don't have that same capacity or data set. So how do you expect that to affect the kind of underlying dynamic of equity markets? So should we expect to see some extreme sort of bifurcation within equity markets as a result of this? Perhaps you can talk us through that.
Yeah, I think it's hard to argue with the concentration in that there is a huge sort of economies of scale effect playing out. Like the insights that we can generate with these AI systems really comes from processing an incredible amount of data, right? And smaller businesses will not be able to do that, obviously, on their own. There's going to be some smaller businesses where they can apply AI in a certain way that is unique, right? And they can maybe boost productivity that way and so forth. But that's just applying AI as opposed to developing stuff on their own. And both could have big impacts on profits and productivity. But it's pretty obvious that there's some players that have access to incredible amounts of data, mostly US companies. There's some companies in China, obviously, where they have access to a lot of data in China, but it's sort of very specific to the Chinese market. And I find it very hard to argue with the notion that these are going to have a competitive advantage in this space, right? So we see these charts all the time with the Magnificent Seven or whatever they call at a given point in time, right? And it looks extreme. But we live in a new world where there are very, very good structural arguments why those companies should have a competitive advantage. So I find it hard to fight, and I would make a different point almost from a diversification perspective. Like if you think about it, and you're an investor, and you have a stock portfolio or a broader portfolio, like what's going to be your sort of stance towards AI? Do you want to be long AI stocks, or do you want to be short AI stocks, right? It's given the potential of this industry to generate profits of its own, but also generate competition for other industries. I think you can even make the argument that these AI related stocks can even work as a hedge for the rest of your portfolio, right? Because if they're actually taking, we can put it in a positive way or negative way, if they're eating somebody else's lunch, right, then you want to have those stock as a hedge towards potentially some damage that can happen in other parts of the portfolio. So I think actually from a portfolio diversification perspective, it's there's an additional argument that these could even be somewhat counter to beta in other sectors, and therefore should be a part of the portfolio. I think there's also convexity, like some of these names like can really lead to groundbreaking new businesses, and therefore there's a sort of option value to them. So
Yeah.
it's always tricky to look at stocks that have had a big run up, right, and say, okay, now they come too far. But on this occasion, there is a very, very good reason why this is something that's going to have a profound impact on how we manage businesses, what productivity is going to look like over the next several years. And there are barriers to entry. There are more barriers to entry in this space than you've seen, for example, in car manufacturing, right? So I know people argue that there's an AI aspect of Tesla as well, right? They also have a lot of training data in terms of automating the driving process and so forth. But nevertheless, the barrier to entry that the leaders in the AI space have is this access to incredible amounts of data that other people would have to buy. They have it for free, actually. And that does mean that the profits that these companies can generate to have a kind of protection that an industrial company, a chemicals company, a car manufacturer in a traditional sense will not have. And I think that does mean that it's hard to say that that leadership that they have now is just going to evaporate when they get more competition. It is actually harder to compete with them as opposed to traditional companies and traditional industries.
Yeah, interesting. And if we look at something else that might exacerbate that concentration, I suppose, while interest rates remain high, what's your take on whether that will actually exaggerate this market bifurcation? Because you've got the mega caps leaving them relatively unscathed, I suppose, while the other players that actually need to borrow and where interest rates matter, they're going to experience a relatively significant drag. So do you see that as exacerbating this issue?
Yeah, I think that goes in the same direction. I've analyzed this issue in many different angles over the years. Like, for example, when you have tax changes in the U.S., there's been a lot of debate in the U.S. about taxing, profits that are stored offshore. If you look at those profits, right, you'll find that it's all the tech companies that account for a huge proportion of them, right? And if you look at who holds, investment grade bonds in the US, you can see, okay, it happens to be the tech companies that own a huge proportion of those, right? So they have a cash cushion that actually is generating income from them now, right? And that's an advantage. You have other players in the market that have high yield bonds that now have, 10% interest, 12% interest rate. They have to suffer from that. So I think that also goes in the direction of bifurcation, certainly. So a lot of different factors that push in the same direction. It's always a matter of degree, right? At some point, the valuation will be too high, right? But there's some very, very good reason that valuations should be extremely skewed in these companies' favor at the moment. And as I said before, like if you can grow revenue 30% a quarter when you're like one of the largest companies in the world, it's not a usual situation, right? And it's something that we've not really seen for traditional manufacturing companies, traditional retail companies, right? So you do have growth potential that exceeds what we've previously been used to.
Yeah, got it. Okay, well, with valuation covered, then let's move on to the wider economic impact. It's highly likely that the services sector will be one of the most disrupted by the AI trend, i.e. the sector that has the most repetitive jobs, tasks, etc. Think of call centers, for example. So to what extent will that increase income inequality? This is something I saw you posit on a previous interview a couple of months ago. So perhaps you can explain that idea and why that's bad for overall economic growth.
It's a pretty complicated topic, right? Because in the past, when we have seen like real sort of technological revolution, a real big step up in what we can actually achieve with a certain amount of investment, that has generally been something that has supported overall economic growth, right? So the question is whether this is something that fits with previous examples, or there's something different about it. So I think one way to think about it is whether is it something that increases efficiency for companies, or it's something that generates extra demand. So when we went through the early phases of the Industrial Revolution, we can think about car production. We had a big shift in the sense that, okay, Ford came up with their very famous sort of segmented way of producing cars that was way faster, way cheaper than a much more manual process, right? And what that did was they could churn out more cars, but it lowered the price to a level where a lot more people could actually afford a car. So that transition had huge effects both on the supply side and on the demand side at the same time. When I think about what's happening now, it feels more like it has to do with efficiency, in the sense that, yeah, the call center, right, can be, you know, manned by a couple of PhDs that handle all the tech associating having robots speak in different languages and accents with their robot call center people, and the people who were previously working there, which could be in low income parts of the United States or low income parts of the rest of the world, they will be out of a job. So it'll be lost income for those people. And if the call center is made more efficient that way, is that going to generate more demand for the call center product? Not really, right? So it's kind of a simple example, probably too oversimplified, but I'm trying to get at this point that the efficiency gains that is coming out of this technology is not necessarily going to boost demand. Like I saw Steven Spielberg made some comments over the last couple of weeks about, okay, producing movies is going to be dramatically cheaper, right? Because the technology is getting cheaper and cheaper. We can do really advanced things in terms of special effects and AI generated movie content that is going to be cheaper and cheaper, right? But is that going to increase the demand for movies? Not obvious, not obvious. So, I think we are going to have these efficiency gains, and the additional profits are likely to go to a significant degree to some very very big players, as we've already discussed, and therefore, in very simple terms, it's going to be a sort of part of greater inequality unless governments do something to intervene, right? So people who've analyzed AI for not just in the last couple of years where it entered the mainstream, but thinking about AI from a more big picture, long-term perspective, they made the point that AI needs to be coupled with a basic universal income, right? Because it's going to create competition for a lot of low-end occupation and services. We need to actually have the government step in and provide basic income to those groups. So that's obviously a political decision to do so, right? But that's kind of like shows you that if we have the benefits, the profits of this technology deriving to a very small group of people, it could really be harmful to the ones that have previously had the jobs that are now getting out competed. And if there's no government intervention, that I think you can argue from a consumption perspective is actually negative for consumption, right? Because Jeff Bezos or somebody like that is not going to consume a heck of a lot more just because Amazon does better. Whereas at the lower end of the income distribution, the propensity to consume is much closer to 100%. So I think those are the effects to think about. But maybe we can talk a bit about productivity as well, because I think that's something that is relevant for macro, right? So when we've been thinking about interest rates, right, and I speak to institutional investors around the world all the time, right, and we've had a huge debate, argument, or whatever we want to call it, about interest rates over the last couple of months, right? So there's two main arguments that interest rates could be high. The one argument is the one we've already talked about a little bit, to do with supply, right? Okay, we have fiscal deficits. We have a lot of supply. There's some of demand that is less robust from foreign central banks and so forth. That creates kind of risk premium. Interest rates need to be high. That's number one. Number two is the AI dimension that has to do with productivity, right? If you think we're entering an era where productivity growth is going to be dramatically higher, then that is also going to have an impact on what you think equilibrium interests are. This famous or infamous concept of our star equilibrium interest rates, and most people argue that there's some kind of link between productivity growth, structural growth, equilibrium growth in the economy, and what that equilibrium interest rate is. And we've now, over the last 15 years, been through a period of very low productivity growth. Call it 1%. Right. So the growth we see in GDP is a function of whatever kind of demographic growth we have and that labor productivity growth. And it's been incredibly low. If you go back to the early, well, call it mid 90s, we have very, very strong productivity growth. And like in some years, 3 to 4. Right. So it's not like a little bit higher than what we have been used to in the last 15 years, but like multiples bigger. So the ones who believe that interest rates might go a lot higher, the ones that think that the AI effect is gonna actually be so powerful that it might lift overall productivity in a very meaningful way. So I work with AI within MarketReader. I think it's fantastic. It's really opened up analysis, different opportunities in terms of presenting content to a big audience, generate real-time insights, but also like just filtering information in these fussy ways that you cannot do with quant models. So it's fascinating and it's exciting, right? But if I put on sort of my economist hat and think about, okay, how's it going to really impact the macro? We already talked about, okay, from a consumption's perspective, we might have a situation where the wealth kind of falls in a very unequal way, and therefore consumption is not going to be so supported. But I think there's also a time frame issue. So when you ask CEOs about, okay, when will they harvest the fruits of these AI investments, most of them say in 3 to 5 years' time, right? So it's not something that is going to be like a big boost on January 1, 2024, right? It's going to come with a lag, and it might be that we're looking into 26, 27 before we can really see it in productivity. So in terms of how interest rates are set right now in the market and how the Fed is going to think about interest rates, it's going to be hard to really have conviction that these AI effects is going to totally dominate GDP figures and so forth. Like we have incredible cyclical swings still from COVID effects, stimulus coming out of the equation and so forth. And those effects have been enormous. And I think in the short term, together with the lagged effects of just having risen rates, is probably going to dominate. And the other argument, even if I believe strongly in AI, has to do with this notion, and they actually spoke about that at Jackson Hole, the notion that it's harder and harder to squeeze extra productivity out of anything. Like, so even if AI is fantastic, even if it is a revolution that's going to allow us to do new things, the sort of counter argument is that if we hadn't come up with AI, productivity would have gone even lower, right? So it's a counterbalance to this problem that is harder and harder to generate productivity gains. So I think we're probably going to get a boost to productivity growth in coming years. But if we think about us coming from 1%, and the sort of peak of productivity growth in the mid 90s was 3 to 4%, I think we're going to have a lift from 1, but I don't think we're going to get close to 3 to 4%, right? So maybe we're going to get to 1.5 if I'm going to just put numbers out there for illustration. This is not precise science, but that would be my best bet, right? And that's sort of a US thing, right? So if you think about where interest rates are heading, like it matters whether productivity growth is 1 or 1.5, right? But it's not going to like totally change whether we need, 0 interest rates or 5% or 10% interest rates. So from that perspective, it also shouldn't be seen as the only force that is driving yield curves and markets. There are other forces, like if I can just mention one, right? We've had a 30-year boom in China that is now turning into a very severe structural challenge, right? So China is kind of going through the opposite, if you will, right? That's also something that's going to matter for growth on a global basis and drag in the other direction, irrespective of whether they're good at AI domestically or not, right? So the cyclical forces can dominate in the short term, even if there's structural shift that goes in the other direction.
Got it. Okay, I mean, there's a lot of points I want to pick up there. Probably one of the more important ones, I suppose, is the policy making impact. You spoke about the Fed and what they do. For the Fed, and I guess central banks more generally around the world, dealing with the uncertainty AI is causing and will continue to cause over that time frame is going to be difficult. So if you look at their kind of track record over the past couple of years in terms of forecasting, it's not been spot on. Do you see this as making the job even more difficult for them, and actually forecasting from CBs is?
I think that's a very important point that you make, that central banks, they're less arrogant. They're less arrogant in the sense that a lot of central bank institutions have this horde of PhD economists, right, that do mathematical, statistical forecasts of the economy, right? And they seem to be very precise processes, right? And now we've had a huge inflation cycle where all those models have effectively been totally wrong, right? So there's less arrogance, more humility in a central bank policy making, which I think the humility is always a very good thing. I spend my career forecasting macro trends. It's not so easy, right? If you can get 60, 70% of the trends right, you're doing a very good job, right? So you need to approach this with sort of a humility and knowing it's a probabilistic game, right? Where you have a chance of being right, but nobody is right 100% of the time. And this is relevant for policy now. And you can see it in how Powell is talking about the outlook, how the Bank of England is flipping their framework very often. Like you can criticize that they're flipping the framework, but at least they're showing a degree of pragmatism. And because of that, the inflation forecasts are not going to be given as much weight as they previously would have been given. It's going to be very much a function of what are we realizing in terms of the data over a 3-month horizon. And we've seen it. We can see it in the market in so many concrete ways, right? We have one US inflation print, right? And the yield curve moves dramatically. The market is hyper sensitive to current data that really shows a shift in the narrative. That's something different. I think also at one of the last press conferences with Powell at the Fed, there was quite a bit of debate about how much smoothing do they do when they analyze the data. But that tells you that it's about the realized data as opposed to their forecasting, right? If it was just about their forecast, it wouldn't really matter so much exactly how much smoothing they apply to the past data, right? So the data in the next 3 to 6 months is going to be more important what different central banks are forecasting. And that goes back to the point I made about the AI, right? If the AI effects are going to come in 2, 3, 4, 5 years' time, the Fed might be forecasting that and have some conviction that that's going to play out, but it's not going to be that something they're 100% confident in. And if they live in a more humble world, they're going to be focusing more on what they see in the next couple of months, right? So that's the environment we're in, and we might be seeing a little bit of impact in the data. Productivity starting to pick up, but it's very hard to know what is an AI effect and what is because productivity has been fluctuating crazily in these COVID times because people come in and out of the workforce. Like, it's so hard to disentangle and be very convinced what is what, and it's that uncertainty that means that you sort of just have to look at everything in a very holistic way and say, I'm going to put a little bit of weight on it as opposed to just making policy based on one thing.
Yeah, yeah, absolutely. And to finish then, just to bring us full circle, I suppose, if they're going to lack kind of forecasting conviction, which makes sense, it's hard for them to respond aggressively in the short term. That also makes sense. Do you expect then central banks, as well as looking at realized inflation, for example, and realized data, will they also put stock in the equity market reaction to this AI kind of hype that we've seen? Yeah, what's your take on that?
Well, we've seen the and we spoke about it in detail on the last show, right, where we talked about, okay, financial conditions have been tightening faster than we've seen in a while, and probably the central banks are going to respond to that and become less hawkish as a function of that. And then we saw that play out, and the equity market rallied very hard, right? So now
Yeah.
everything's kind of flipped within 5 weeks, because actually financial conditions are not that tight anymore. So that means that they're going to have to flip again. So it's a tricky thing to set policy based on financial conditions, because those financial conditions can flip very fast, which is exactly what we've seen. So that means that the anchor is inflation. The anchor is inflation, right? That is their mandate. That's their target, and they'll have to look at that, right? So if I'm going to say, okay, what's the one variable you want to look at to determine whether the Fed is going to cut rates within a reasonable horizon, it is going to be that essentially inflation on a broad basis, especially services, start to get meaningfully closer to target on a trend basis, right? So I said maybe on 1 month basis, we had something that smelled like they were closer to target. That's clearly not enough. And I think we're going to have it bouncing back and forth a little bit. But if the trend over the next 3 to 6 months is something that looks like they're clearly gravitating towards target again, then they don't need 5.5% rates, right? So, and this I think is something where we have to be very, very focused on both levels and changes, right? In the last cycle, we only got to slightly above 2% interest rates, and then they could cut rates. But okay, cutting rates 100 basis points was a big deal from slightly above 2. If the Fed reaches the conclusion in coming months that inflation is under control, then they don't need 5.5 anymore. The long-term dots that they write down, what they think is the equilibrium, maybe their models are flawed, but those are the ones they've written down, is 2.5. That's what they think the equilibrium is. Not easy policy, not tight policy, but just getting to what they actually written down they think is neutral is 2.5. So that's 300 basis points from where we are now, right? So if they get comfortable with the inflation outlook, certainly 200 basis points of cuts would not be a dramatic thing. It seems like a very dramatic thing because we're used to having such low interest rates that 200 basis point would essentially exhaust all the room down to zero. But that's what's different now. We're at 5.5, right? And that means that once they're comfortable, they could do 200 pretty quickly. And that means that stocks that are sensitive to interest rates can definitely move. And we've already seen like a prelude to that.
Yeah, absolutely. I think that's a fantastic insight to end on. Fascinating discussion as usual. Looking forward to the next one. That just leaves me to say thank you very much for joining me on the podcast, Jens. It's been a real pleasure.
Good choice of topic. Hopefully we can get the timing as good as last time, but that's what we have to be. Thank you.
Cheers, Jens.